Beginning investors face many questions. When should you start investing? What should you invest in? How much money should you invest? If investing is so important to get ahead in life, why does it seem so complicated? While it might seem hard to understand at first, it really doesn't need to be complicated at all. What if you could get some tips that would almost guarantee success and put you on track to become a millionaire? These are 8 of the best tips for beginning investors that can help you get your portfolio started and ensure its profitability until retirement. Number 1 is perhaps the most important tip that most people wish they knew at the beginning of their career. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 8. Start with broad-based investments. One of the first questions a beginner investor has is what to invest in. How are you supposed to know what to buy when there are seemingly endless choices between individual stocks, sector-specific funds, and broad market funds? While there are many options, it's best to begin with something simple that's easy to understand, such as an S&P 500 fund. Even those who have never invested in the stock market have probably heard of the S&P 500. Owning a fund such as this with about 500 profitable companies is an almost foolproof way to invest, as you're essentially buying the overall stock market. With this, your returns and risk will be about average. You might decide to stray from this a little bit by purchasing a low volatility or high growth variant, which is also a great way to start. Buying and holding this type of investment is a simple and proven strategy, whether you're investing $1,000 or $1 million, and is highly recommended by Warren Buffett. Number 7. Don't be scared off by the media. The media's goal is to get more views, which is accomplished with scary headlines and nerve-wracking stories. Seasoned investors know to ignore this for the most part, but it can be unsettling for those who are just beginning to invest. Your goal as an investor is to grow your money over time by focusing on things you can control, such as your time horizon, risks, costs, and taxes. When the headlines are scaring people about the potential end of the stock market, try to focus on the long-term picture and make sensible decisions. Take a look at history and you will see that the stock market has always recovered from any sell-offs. Even though the stock market behaves like a roller coaster with many ups and downs, you won't be injured if you don't jump off. Try to stick to your investment strategy no matter what happens. Those who were unemotional during past recessions have profited nicely, while the ones who sold everything took the biggest losses. Number 6. Focus on your savings percentage. Beginning investors can be discouraged by poor market performance over a certain period of time. There have been many times when the stock market's returns have been less than desirable for a short period of time, but your job as a beginning investor should be to concentrate on what you can control. Instead of focusing on market performance, consider how much money you're saving, if you're doing it consistently, and if you could save more. For long-term investors, the biggest factors for success are staying invested and saving enough money. As a rule of thumb, try saving at least 15% of your income, more if you had a late start or plan on retiring early. Even if the market performs poorly for a certain period of time, be assured by its long history of profitability. Number 5. Set investment goals. One of the most important aspects of an investing strategy is knowing your goals. How much money do you need to retire and when? How much money do you need to save each month to get there? Lay out your short-term, medium-term, and long-term money goals. A short-term goal might be saving enough for a vacation next year. A medium-term goal could be saving enough for a down payment on a house in 3 to 5 years, and a long-term goal could be relating to your retirement. Try utilizing a compound interest calculator with inflation to get an idea of how much you need to reach your investment goals. Having tangible goals will help you see the progress you're making, and it will give you motivation to stay the course and find out what you need to do to reach them. Number 4. Understand how much risk to take. Deciding how much risk is acceptable for your portfolio will depend mainly on how long until you retire. If you're 30 or 40 years away from retirement, taking more risk in exchange for higher returns is usually worth it. Additionally, you want to be comfortable with the risk and recognize the potential downsides. Younger investors generally have a higher risk tolerance because they won't be using that money for many years. The downside to more risk is that at times, the portfolio will perform very poorly. A more conservative and less risky portfolio will perform more steadily but with lower long-term returns. Understand how the risk of your investments will relate to your overall returns and ultimately how much you will end up with down the road. Number 3. Keep costs low. You can't control how your investments perform, but you can control how much you pay for them. As an investor of any level, it's very important to pay attention to the costs associated with any investment. These fees are usually in the form of an expense ratio, which is how much the investment firm charges you to own their fund. Consider what these two companies charge for an identical fund. The S&P 500 ETF offered by Vanguard charges an expense ratio of 0.03%, while SPDR charges 0.09% for the exact same investment. With a $100,000 investment, Vanguard would charge $300 per year, while SPDR would charge $900. With a $1 million investment, that's a difference of $6,000 per year or $500 per month. That might not seem like a large amount, but investors often underestimate the ability of fees to eat away at your portfolio. That difference is multiplied as your portfolio grows, and the fees could even end up being more than your monthly contributions. Number 2. Automate your savings. An easy way to stay on track with your investment contributions is by setting up automatic contributions on a weekly, bi-weekly, or even monthly basis. When the money is automatically taken from your account or paycheck, you're not tempted to spend it. Additionally, the less you have to do, the less overwhelming the whole process will be, and the more likely you are to stick with it. Almost everyone who automates their investments will tell you that they hardly even realize the money is gone. Just think of how less likely you'd be to invest and how much more painful it would be if you had to manually transfer the money each week. Most people would either forget to do it, put it off to a later date that will never come, or they would just hang on to it and spend it on something frivolous. Number 1. Start now. The biggest barrier to investing money as a beginner is simply getting started. Too often, investors are scared off by the topic because they don't feel like they know enough about it, or it's not something they think they need to worry about until later in life. They might also feel like they don't have enough to begin and it just isn't worth it yet. You should begin investing as soon as you have your income and expenses in order. It might be a good idea to pay off high-interest debt before investing, but the earlier you can begin, the better. Don't wait for the perfect time to invest because it just might never come. Time is your biggest advantage when investing because it gives your money more time to compound. Even if it seems like you barely have anything to begin with, a quick look at some simple examples of compound interest could show you just how powerful it can be. These tips will help you succeed not only as a beginner investor, but over the course of your investing career. Focus on what you can control instead of what you can't to avoid being emotional, and invest no matter how the market is performing. Automating this will make the entire process much easier to continue over the long run, ensuring a prosperous retirement.